Podcast is now starting. All attendees are in listen-only mode.
Can you see my screen with my little logo?
Yes, we can. We're live.
Okay, good. Hold on. Let me just make sure. Just tell me, did that change?
Yep, that changed.
All right, good. Yeah, it's going to be good. We have a lot. I've added a few extra things at the beginning, which is good, even more than I gave you in the list. But, I think it's important, especially a little PPP update and SBA. And hold on one second.
Who's that? Who is that? Who is that?
All right. There you go. I'm back. You can still see my screen and hear me?
You're good. And all the attendees, as they're rolling in, they hear you and see as well.
Okay, so maybe while we take a minute, let people, I know it's 5 o'clock, so again, I'm always in no rush. So anyone has any questions for me, just put them in the chat. I believe I have my questions window up here. So please, anyone ask me anything right now. Don't have to wait for me to start the presentation. I'm just going to stop sharing my screen for a minute so everyone can see me now, right?
Perfect.
Okay, so let's give it a few minutes here. Because everyone still has a lot of questions about PPP and the EIDL and, a lot of things like that. So I'm just going to touch on a few of those things, if you don't mind. And also talk about some of the things happening with people leaving some major cities. You'll see it up front. It's good. Are you going to record this? You are, right?
It says it's being recorded right now. Yeah.
All right, good.
I didn't set that though. It might have just automatically switched over when I upgraded. Yeah.
Yeah, that's great. So let's at least we'll have it, and we can, what I can do is if you let me have a good copy, then I'll make a really good media post like I normally do, and then I can share that with you so people can see it without you having to host it anywhere. I'll put that all together so everyone could watch it at their leisure, all the other members.
Perfect.
All right. Who else is here? Let's see.
I'm here.
Louisa's here. Hi, Louisa. I know Louisa very well. A lot of people I know, familiar names. There's Louisa. Hi, Louisa. Good to see you too. I would like just even to start. So how does everyone feel? How does everyone feel about the current inventory out there? About pricing. It seems that, I think going to be an uptick in pricing, but I go over that a little bit. So everyone knows part of my feeling is people need to spend a little more time thinking about investment property sales because everyone wants to clamor to sell the forever homes. But all right, good. Got a few more people. Let's give it another couple of minutes if that's okay. Just want to give everyone a chance to get in. Is that okay?
Absolutely.
All right, great.
And for anyone that is already situated and has any kind of questions for Chris, you might be aware of this format that we've been using for our webinars, but you can actually submit questions through them in a text feature. It's in the questions panel. So you just scroll down until you get to the questions bar, expand it down, and submit it right there. Chris will then be able to address your question during this webinar, which is great. Just get any kind of questions answered that you have, in regards to unemployment, PPP, etc. So feel free. This is what we're here for.
Exactly. I just got a chat. Hi, Chris. This is Sue. We just talked, and I'm attending your webinar. Great. So I just was on the phone with a member. She works for Keller, and I said, "Are you going to be on? On with me?" She's like, "I didn't even know." So She just jumped on too. Let's see here. So yes, this is Eileen. Yes, definitely Eileen. Remember and I go over this, but the PPP and the unemployment are mutually exclusive. But you can definitely get and should be applying for the EIDL as well. And remember, the EIDL is a loan. And if you do get the PPP, none of the EIDL, even the grant portion, is free. But yes, the EIDL is a long-term loan, very low percentage rate. It's definitely something to have, in your back pocket, just as a reserve. There's never a prepayment penalty. So yes, you can get the PPP and the EIDL at the same time. And you can't keep eventually the unemployment and the PPP. That's important to remember. So what I'm telling everyone to do is get both the PPP if you can and the unemployment, because we're still not sure how much total unemployment we're getting. And then at the end of it, in a few months, we'll see what's the better benefit, and the lower one we're going to return. But I tell everyone, don't worry, don't be nervous. You're not doing anything illegal. We need to know what's the better benefit, and then we'll return the other one. So it's going to be a waiting game and take your time. But everyone has every right to see what their maximum benefit is everywhere and give back the lower one. Does that make sense? Eileen, did I answer that question okay? Okay, good. Christine Finley, good question. Still waiting for pandemic unemployment. And remember that the state systems that we're using are a little antiquated, but they never were geared towards self-employed people like us to get benefits. So I have to admit, although there's some negative about Murphy out there, they've really done a good job trying. Remember, we're using the state system in a way it wasn't designed for. So they're doing the best they can. They are getting people the benefits over time. They're working overtime. So the fact that you haven't gotten a benefit yet, don't think that there's something wrong. It's just that they're doing 50 times like imagine you had to do 4 open houses in 15 minutes. You probably couldn't get them all done. So be patient. Wait another couple of weeks. If you still haven't heard from them, then try to inquire. But everyone's used to instantaneous responses to things because of the internet, and this is taking longer, and it should, but they're doing a pretty good job. So I don't want anyone nervous that they've lost anything or the benefits aren't coming. Okay, did that help, Christine? Right. Christine is running out of patience. I know. My whole day is spent for the past 2 months saying it's going to be okay. Let's be patient. I know. But the benefits are not running out. If you're due the benefits, you will get them eventually. So this happens with the stimulus checks, a totally separate issue, right? The stimulus checks, some people haven't gotten them because they're staggering the checks based on income a little bit. So some people might not get them to July. So again, nothing wrong. It's just we just have to be a little patient. I know it's very hard, especially when we're not collecting a lot of money in business. Patricia, let's see. I still haven't received acknowledgement from the IRS that they received our tax return. All right, so Patricia, do you mean that did you try to e-file it yourself and it hasn't come back? Are you using TurboTax? How did you file it exactly? Let me see that in the chat and then I'll answer your question. Okay, so if you physically mailed in your return, it's going to take many, many months. They haven't even opened that envelope yet. I know that's frustrating, but with the lockdown, like everyone else, there's a skeleton crew at the IRS. So paper returns are going to be probably handled in a few months. Is it possible that we can e-file that for you? Can we get an e-file done? Was there a specific reason? You don't have to say it in the chat. Was there a specific reason why you didn't e-file the return? That was it because it couldn't be e-filed, or you just chose to paper file? Let me see that answer there. But again, the paper returns are going to take a long time for them to physically even open them. Let's see. Just waiting for Patricia to give me an answer. Okay. So yes, so you're going to have to wait for them to open that mail, and it could take several months. I know it's frustrating, but I hope this gives you some consolation that there's nothing wrong. They're eventually going to get to opening those returns and getting them processed in their system. I hope that answers your question, although it might not be the exact answer you wanted. I'm trying to tell everyone most of these questions. I know it's frustrating, but don't think anything is wrong, and we just have to be patient. Let's see, Elizabeth Scott. I received my stimulus check based on my 2018 return, as my 2019 was not filed. I could have received a good amount more, but was based on 2019. Do you know if we can update based on 19? What's going to happen is that when you do your 19 return, or even your 2020 return, there might be a way to do that. So you're saying, Elizabeth, that your stimulus check was not $1,200 per adult? Right, because remember, the stimulus checks, everybody, just a little information on that, that a married couple, for example, if making over a certain amount of money, it starts to phase out the amount you can get for stimulus. So in Elizabeth's question here, we have the 2019 income might have been lower. Right. So in 2018, as Elizabeth just said, she might have made over the max. So 2019, yes, I would file your 2019, and if that's lower, that might trigger you to get a stimulus if you're under the range. So I would get your 2019 return as soon as possible. And if it doesn't trigger something, eventually there should be a facility to ask this question and hopefully get the stimulus. But your best bet is getting that 2019 e-filed as soon as possible. Does that make sense? You're very welcome. Oh, it's good to get a lot of questions ahead of time. This is great. All right. Okay. So we have 17 people here. That's good. Everyone can still hear me? Just let me know you can hear me. Oh, great.
Perfect.
Thank you. Okay, great. Okay. So it's 5:15. Maybe we can get started.
I'm ready when you are.
Okay, great. So let me just share my screen. Let me know, is my questions window in front of my slide? Or is it just my slide?
Yep, that's only going to be just on your screen. We won't be able to see. You'll be good.
Right, I'm saying, so all you have is my logo on the screen now?
Correct.
All right, great. I'm going to put the
Just
question
your logo
box
and your
back.
camera.
I got my question box here in case, Lauren, if you see a question, just pause, just stop me, okay?
Yeah, if anything, I think we might have just missed one from Christine.
All right, let's look. That was in the questions box?
Yep, it was right above Elizabeth's.
Okay, let's see. Okay. If I'm patiently waiting for pandemic unemployment, can I apply for the Jersey EDA, the PPP? And I was told EIDL was not, no. So this is excellent. A bunch of questions in one question, Christine. Thank you. So yes, you should apply for the NJEDA. There are possible grants there that businesses can get separate from all the federal. So you should try that. I have a very good blog post about that. That you can go to my blog page and you can see it right there. It shows you there's a questionnaire to see if you qualify, and then the application is right there. I urge everyone to try that. Now, as I said before, no, the EIDL, what happened with this, what Christine is asking, are they only processing agricultural applications or farmers for the EIDL? No, what happened was, remember, the SBA got 15 years worth of applications in 15 days. So what they did is they did small business, and then they took a break, and they wanted to get farmers a chance. So they just segmented it to give them a 2-week span. And then they went back. So no, the EIDL is totally functional. You might be delayed, but definitely go on and apply for that. What you wanted with the EIDL, you want to get a confirmation number page, and eventually they will get back to you. It could take a few weeks, but you want to get in there, as I go over that a little bit in the presentation here too. Okay. Let's see. Hopefully you could see me again. I wanted to. Right. So and remember, you want to apply for the unemployment. And when you do apply for the unemployment, remember, you want to use your name and your social as the boss and who you work for. Do not use the realtor or the agency you work for. Remember, you're a sole proprietor, so you don't want to put Keller Williams or put Weichert. And no, you want to put your name. And what I tell everyone to do, if you haven't done unemployment yet, say that you were terminated from yourself on February 28th. And that'll at least get you in the system and eventually hopefully start getting you some federal benefits. Okay, Christine, does that make sense? Just want to make sure I answered your question before I start here. All right. Hopefully I answered the question. Excellent. Thank you, Christine. All right, good. I'm going to share my screen again. And just again, let me know if all you should really see is all you should really see is my logo right now, right? Lauren, is it, you see that?
That's it. Just your logo and you on top. You're good.
Okay, great. So we're going to get started. All right, good. We are ready. All right, so just a little introduction. I'm Chris Whalen, CPA. Many of you know me already. I do a lot of work with real estate brokers and agents, investment property strategies, your tax benefit analysis for clients, especially commercial ones, a lot of opportunity zone, 1031 work. So I urge all of you to please make sure that you have me in your phone. Many agents, even not my clients yet, call me on a regular basis when they're with a client. They could use CPA expertise to help them close a deal. So I'm definitely available for that to help you to become part of your team, to make sure that you solidify the business for yourself. Of course, we do all of the normal CPA work you'd expect, individuals, businesses, etc. And my motto, of course, is if we aren't working for you, then you aren't working at your best. You're almost there, but you need me to get to 100%.
Hello?
All right.
Hello?
Hello? Someone, I thought I heard a voice. Okay. So everyone, please take a look at the screen. My website and phone number are there. They're both great ways to reach me. But subscribe to my blog. Send me an email with blog subscription, and so then you get my updates on a regular basis. It's pretty good information. It's information you can use and your clients can use. It's never selling. It's just really good, actionable information. So I say there's going to be Q&A, of course, throughout. Ask me a question. But I often say I'm going to give you so much A that there's very little Q. So use the chat box to ask me anything, all right, as we go. And definitely interrupt me. I love that. Don't wait till the end. All right, so the first thing I want to talk about is the coronavirus impact on real estate. So this is really, really significant as it's changed the whole landscape, especially for suburban residential real estate and commercial real estate. So there's an exodus out of major cities, and this will continue. Why? Well, there's unrest, there's riots in specific cities. The leaders are no longer trusted to protect everyone. So homeowners and businesses will not return until it's made safe again. Remember, the lockdown, I have a lot of clients in big cities. The lockdown feels like a prison to these people. They have a high rise on the east, the Upper East Side, but it suddenly feels like a prison. The lockdown in the suburbs, though, are much safer, better quality of life overall, right? So suburban home prices, especially in here, should continue to benefit, and investment property prices in suburbs are also better. We can't forget about the suburban investment properties. So, but Chris, isn't this temporary? No. Don't forget that remote work has taken hold. The need to live near big city offices will continue to decline, increasing suburban home values. This is great for realtors in the suburbs, which is all of you watching. Remember, consider expanding your usual market area, meaning you have all these people in New York who don't want to just be in Monmouth, Ocean County. You know, we should be learning all about other regions of New Jersey that people would want to move to. So this can expand your market area greatly. I would market directly to big city dwellers and business owners being important, right? So I would market to business owners on a national basis. Remember, there's right now, unfortunately, there's Jersey businesses that are now shuttered, both retail and office, but they're prime locations for big city businesses fleeing the destruction. So remember, so we can turn some of these vacant commercial spaces into opportunities for people coming into the state, right? These could be part of a national marketing plan. For example, there's no reason why a Minneapolis business that lost everything should not consider New Jersey for relocation with their insurance proceeds. Think about that. There's people there, they don't want to rebuild, they don't know what to do. Well, there's no better person than a realtor to spearhead an effort to educate those people why it's good to come to New Jersey. You're the experts, right? I want to show you. This is from today. This is Wall Street Journal today I got. Housing market around New York City is booming. All right. Looking to buy outside the city. This is in real estate, by Boston.com and Globe.com. The young are joining the rich, fleeing America's big cities for the suburbs, right? Business Insider the other day. San Francisco home buyers are fleeing and snatching up houses, right? This is very, very important. I found this in the New York Times. This is a graph showing mail forwarding requests. Look at March and April. Stunning. April, 80,000 or more people are forwarding their mail. These people have to live somewhere, have to rent somewhere or buy somewhere else. Complete opportunity for us here in New Jersey. All right, good. So I hope that helped give you a little maybe different perspective on what's happening. I want to go over a little PPP SBA EIDL update right now. We just went over some of that. So here, most independent contractors should apply for all three of these, the PPP, the SBA EIDL, we call it, and unemployment. Remember, you can only take one of the PPP and unemployment. I urge everyone should try, anyone that had self-employment, realtor income last year should try to apply for all three of these. Very important. So remember, you can only take the PPP or unemployment. The EIDL is separate. You can always take that. There's no exclusion. But when you have the PPP and unemployment, you can take the higher benefit like we talked about. Yes, even with current income. Remember, if you're a real estate agent and you're getting unemployment right now, and they want you to certify your benefits, let's say you got a check this week for a $10,000 commission. That is not the number you put down, because remember, it's really net income for self-employed people. If your income is going to be down, you might not even break even. So I'm urging my self-employed people, including realtors, unless you're sure you're going to make as much money as last year, when you certify your weekly income, even if you received a check, I would put 0, because we don't know what your net income is. It's definitely not 10,000. So it's a very important point. I get that question like every day when you're certifying benefits. All right, so remember, get all the applications in, you wait for your responses, and then they're going to ask for more information. Remember that the applications are sparse for these. So especially for the EIDL, you don't even know what the loan amount is. So even if you do get a response from them, you might need to provide them more information. I'm just trying to manage your expectations because everyone's chomping at the bit to get money. Then you receive the funds. Remember, PPP forgiveness is limited sometimes. As soon as you're approved and receive funding in any program, please be sure to call me before you accept it if you don't have another accountant that you trust implicitly, so I could at least give you some direction when I hear the facts behind all of your cases and your loans and stimulus here. Now, very important point, this is the only slide for this. New Jersey real estate agents cannot form an LLC or an S Corp to report their annual real estate commission income. They only can do a Schedule C. And this is really true. People will argue with me, but I have a letter from the Banking and Finance Commission that says that. So anyone here If you hear of someone doing this, or if you're doing this, it's illegal to do that. All right, now we're going to get into Accounting 101 for business owners, which is popular to go through some of the things, especially I sort of customized this, of course, for this presentation for all the real estate agents who are watching, right? So record retention. We need to keep records for 7 years for all business and personal tax supporting documents. Again, anything that goes on a tax return as a deduction, you really need to keep. Do you need to keep any other receipt that doesn't involve your taxes? Really not. Right? So the IRS could go back as far as 6 years if they wanted to ask you for support for something. That's why I say 7. It hedges with an extra year. This is a Schedule C form. A lot of you know it. But some of the new realtors out there, this is the form that you file at the end of the year to reflect your income from real estate. This goes on your 1040 form. This is what you have to file as a real estate agent getting commission. This is the corporate return that sometimes people erroneously file. If any of you are filing an 1120S that looks like this, please contact me after the presentation. Okay, so let's go over deductions. Any payment that you make that relates to your business can be deducted. So I get the question all the time. It could be things no one else is deducting, but if you know it relates and you have a receipt, we are definitely going to take it. So some are a blend of personal and business. For example, let's say you have a credit card that's some are business expenses, some are personal. Well, what I do at the end of the month, you download those transactions and you make 2 columns next to your amounts for each charge, and you put them in business or personal. You total it up, and what I do is I pay with 2 checks online. I have a business portion and a personal portion. I've paid 100%, but it lets me segregate my business from my personal very easily, right? What if you have cell phones with family members? Do the same thing. I have 2 children who are freeloaders. I mean, children that I love, and I pay 1/3 with my business and 2/3 with my personal. Perfect. So I've segregated the expenses, and only out of my business account, and now everything is perfectly segregated, right? Your Easy Pass, same idea. Credit card charges, as I've said, right? All right, so I know that everyone listening, because you're great members of MORR, all of you have a separate business account for your real estate transactions. There's no one in the organization that commingles their personal information with their business. Of course, I'm laughing right now, but I urge everyone, please, just in your name, to get a separate checking account that's in your name, but it's used just for your real estate and your expenses and your income, and you take your money out of there to pay your personal expenses, because it makes it easier at year end to account for it. But if the IRS comes calling, one of the first things they want to see is your checking account. Now, if I have it segregated, great, I can send them my business account. But if everything's commingled, I have to send them everything. And I'd rather avoid that. So please, I know it seems like a pain, but get a separate business account for your real estate, and just it doesn't have to be a business account, just in your name. Don't even tell the bank. It's Chris Whalen, Realtor. It's a real estate account. Just put my name on it, and it makes it much easier at year end. Canceled checks are very important. We don't write a lot of checks, but when we do, the banks don't automatically give you those copies with your statement. They say, oh, it's in the vault online. No, you want to make sure that when you download your PDF bank statements at the end of the month, those copies, those little images of the checks are on white sheets in the back. Everyone knows what I'm talking about. If they tell you to click and print them, absolutely not. TD Bank will give them to you, Bank of America. Most banks will do it. Make sure you're getting that, because when you write a check, the IRS wants that check for proof, not the receipt. So make sure you have all your canceled checks, no matter how many you write. Online bank storage is not enough. Home office deduction. Everyone, please say it with me. It does not trigger an audit. Almost every realtor believes this. It's not true. And it does not reduce the basis of your home. Every real estate agent has a home office and should be taking the deduction. If you see on your Schedule C last year towards the bottom, there's no home office deduction, you have definitely overpaid your tax. So please call me about this, and it's very significant. Now, a lot of realtors don't think they can take it, or they're afraid. Don't be afraid. A lot of money is lost here, so please contact me after this with questions. All right? Now, the home office, Usually you need to add up a lot of your expenses on your home and then take a part of that as a deduction for exclusively used space. But we can take even a safe harbor method and get $1,500 deduction. For some of you with your self-employment tax being saved, that could be a $500 saving. So even if it seems like a lot of work, well, the safe harbor method is a way to get a deduction that saves you some money. It's not that hard for your accountant to do, okay? Let's talk about mileage versus gas receipts, okay? Lauren, is my pace okay here?
Yeah, you're perfect.
Okay, great. So this is the rule that mileage versus actual, the higher your mileage, usually the mileage method is better. So what this means, everybody, is that we can take either a mileage rate, let's say it's 58 cents a mile, we can take that, or we can take actual, like gas toll, the gas maintenance, insurance, depreciation on the vehicle. We can't take both. So most realtors have a high mileage, and it's usually better over time to take the mileage method. Now, in the first year you put a car in service, you need to make a decision. You can't switch. So I have a 2018 Camry, let's say, and I have it now, and I had the mileage method in 2018. In 2019, I can't switch to actual because I had a lot of maintenance. You can't do that. You have to make a decision and stick to it, right? And you must use it forever. Remember, leased cars can also use the mileage method, right? But mileage logs are required for both. And remember, tolls and parking is not part of that. So always take tolls and parking. People often make the mistake of thinking that if I take mileage, my tolls are included. No, that's no matter what method you use, mileage or actual, your tolls or parking is separate. So make sure you give that to your accountant, okay? So here, the mileage rate for 2019 is 54.5. The mileage rate for 2020 is 58 cents. All right, so if you have, like I said, you have 20,000 miles on a car for 2019, that's almost a $12,000 deduction. It's very hard to get actual up to that point, as you can imagine. Plus, I can't go into it now, but over time, if you keep your car, the longer you keep it and it's paid off, the mileage rate can astronomically pay for itself over and over again. That's why I always use it. I'm a high mileage person too. So make sure you look at this and make sure you're analyzing it correctly, and then make the right election. Now, mileage logs. Many of us don't keep track of our daily travel. I know it's a pain, but the IRS writes you a letter. The first thing they're going to ask a realtor is, give me your mileage logs. Give me your proof of all this mileage you've taken. And if we don't have it, like in our example I just said, there's a $12,000 deduction, let's say, they're going to add that back and charge you tax on it. So I try to go over a few things here to help you comply in case they ask you, right? Under audit, right, they're going to ask for this, and it can be denied, as I just said, if you don't maintain adequate records. So what do? What are the basic IRS rules? Now, this is if you lease a car or if you bought a car. There's no estimates allowed. Every time I do a live seminar, people say, I just estimate. I'm like, well, you're wrong. And they say, well, I've been doing it for 20 years. I've said, well, you've been wrong a long time, right? So we have to have it close to exact mileage only. We're supposed to itemize each trip with the business reason listed, and then we have to total that. So I showed this next screen because when I wrote to the IRS 20 years ago, I said, can you send me what you recommend for a mileage log? They actually sent this to me. This is from the IRS. Look at this, is crazy. For every time you get out of your car to a new destination, they want your odometer and the miles in that trip. That's not going to happen. So how can we comply in case we need to without it being too onerous? So what do? Well, there are mileage apps like Mile IQ. That's sort of helpful, but it is limited. You can swipe this, swipe that. So what I suggest is to use your calendar, right? Everyone here should keep a calendar every day of where you're going, how many appointments you have. And so remember, from the moment you leave your house until the moment you come back, it's business miles for you because you're really a home office worker. So we want to make sure we have a destination in the calendar event. So if you're going to be bringing me to a new house tomorrow, I want to list that house. If I'm going to multiple towns, I want to list that as well. All right, that's very important. And I want to print that out monthly because I'm not keeping mileage exactly, but think of it. If I'm living in Red Bank and I'm going to Tinton Falls and Lincroft and Marlboro, I eventually can total that up and say I came home. I can have a spreadsheet done that lets me total up all the mileage if I need it. And plus, always put the client's name that you're bringing if you're going with a customer, a client, because we need that information too. And if you look back in the prior screen, it needs a business reason. Well, your business reason, I'm showing home. So that's always your business reason, okay? So this is important. If you keep your calendar as tight and just maybe keep a little more detail, it goes a long way to complying with the IRS rules in case they ask you a question, right? So this is the other thing. What else can you do? Well, Happy New Year, as I say. The first of every year, January 1st, take a picture of your odometer, because remember, the mileage method is the most important component of that is total mileage, right? So a lot of people don't have that, and please don't think you can go to Jiffy Lube and see when they did your mileage. That doesn't know. We want to have this picture. So that goes a long way to showing them how many miles you drove. And that will go a long way to them agreeing to things, because they know how much mileage realtors do based on their income. So please, everyone, put a little calendar entry for January 1 when you're bleary-eyed from too much celebrating. Go take a picture of all the cars' odometers, and please send it to me so I can archive it in case you don't keep it. That'll be great. So this is an important step. It really helps a lot when you're scrutinized for mileage. Do you need to pay estimated taxes? Let's go back. Yes, you need to pay estimated taxes. You're a self-employed person. A lot of agents try to wait till April 15th, and you can't. They expect your income comes all year. You need to pay 4 quarterly estimates for federal and state, or else they're going to get you for late payment penalties. So please, especially any of you that had income, let's say in 2019, hopefully your accountant gave you estimates to pay for the new year. If not, then please call me. We need to get them, because you have to pay quarterly. I understand that your income is fluctuating now and that it might be lower, but we still need to do estimates and at least talk to me once or twice after tax season to adjust your estimates. Very important, because those late payment penalties are severe, and they can be easily avoided if we just do the right thing and get the right direction. Now, meals and entertainment, this is another thing that was changed. Remember, entertainment and meals are not the same thing. Entertainment are tickets to the Yankee box seats. It's paying for hotel rooms in Atlantic City, or paying for tickets to a Broadway show. Business meals, which is much more of what we do, are still fully deductible. Well, it's 50% deductible, but they're deductible as they always were. So when you take me out to lunch, you can deduct that, right? And I urge everyone to take me out to lunch. I'm just kidding. But remember that not a lot of us have entertainment expenses. So please keep track of your meals. Now remember, though, when you buy food for something, let's say you have an open house, when you're buying food, that's not a meal there. That's marketing, because I don't want that limited. It's not a meal. So when you sit across from someone and you're buying them lunch, or you bring lunch in for a client specifically to meet with you, that's a meal. All the other food you buy for open houses, or even in the office for clients or whomever, or if you give a seminar, like for example, when I give a seminar, if I bring food in, it is definitely marketing expense. Very important distinction. A lot of realtors, when they have an open house, they put that food they buy to meals, and they're losing out because they're limiting their deduction. And of course, anyone here, if you have any question at all before you do anything, text me or call me. I get questions all the time about how to categorize things. I love phone calls like that. I always tell everyone, the moment you think you're bothering me, call me. All right, so gifts, very important. If I ask everyone here to raise their hand and tell me how many of you give gifts in business, you'll all raise your hand. And I know technically you think you're right, but there are no gifts in business. They're only marketing expenses. So a gift is when I give my beautiful children Christmas gifts, and Christmas morning they open them up. That's a gift. The only reason why we're buying a Home Depot gift card for a new homeowner is because it's a marketing expense. If we knew we'd never get any business from them again, or referral, we might not do it. So I never have gifts on my tax return, because per even the definition with the IRS, it doesn't apply. So and this will also save you money, because people know right now there's a limit of a gift of $25 per person for a year. So people avoid giving gifts because they think it's not deductible, but don't think that. Gifts and giving a marketing, like I said, a gift card, anything, that should all go to marketing expenses and not gifts. Very important point here. So a lot of realtors believe that they're giving gifts, and I say we're not. All right, I want to talk about retirement planning. This is very important that a lot of realtors don't know. You are a self-employed person, so you can put into a special IRA, or it's called a SEP IRA, and it lets you put in money that's based on your net income, like other business owners, and a lot of people don't realize this. So let's talk about this a little bit. So Linda's a realtor like you. She doesn't have any employees, but you want to put money away for retirement, right? So you're eligible for a SEP IRA because you're self-employed. Perfect, right? So what happens is you can put away up to, if you look at this screen, you can, in 2019, you could put up to $56,000 away, and that's based on 25% of your net income. So if you make $100,000 net income from a Schedule C as a realtor, you can put away $25,000 approximately. Now, what's good about this is that you get to deduct that right now. So if you're in a 50% tax bracket, that's going to save you $12,500. So think about that. You can put away $25,000, but because you're saving taxes, it doesn't cost you that much. So I urge everyone to talk to your financial advisor or talk to me about it. Everyone should be saving towards this SEP IRA every year because it's a no-brainer. It's your money. It gets invested, and you get a tax break right now. And a lot of people don't realize this is available for you. And I urge everyone to learn about this. This is the best tax deduction that self-employed people don't know about. So talk to your advisor, talk to me, talk to your accountant. I have a lot of information about this, so I'd be glad to help you understand it. And remember, you don't have to put that money away for 2019 until your tax return is filed. So people are on extension now for 2019. Let's say in our example, you can put away $25,000 for 2019. Well, you can wait till October 15th with extension to pay that money. So think about it. You can wait to get your summer money in, and you can put away money right now in 2020. You can deduct it in 2019. So it's totally flexible for you to do it. So again, write to me with any questions. I'm glad to help. So let's talk about the pass-through tax breaks or qualified business income. Remember, all the real estate agents here should be getting qualified business income tax breaks. This was new with the Trump tax reform, and I still see tax returns where it's not being taken properly. And this gives you a 20% tax break on your total income, total taxable income. So the Trump's tax plan includes a qualified business income deduction. This gives you a 20% deduction on certain business income. It doesn't usually apply to passive income, though, such as rental property. But for your self-employment income, you are a perfect candidate for this, right? So most real estate agents will get a 20% reduction. So in my example, we have $100,000 of income. From ordinary tax perspective, you're only going to pay tax on $80,000, right? It's amazing. We want to make sure, though, that your accountants are doing this the right way. I unfortunately have seen some real estate agents that have overpaid tax because this wasn't taken or calculated correctly. So here's a really good example from new and old law, my $100,000 example. So let's take a look at the old law all the way to the right, right? We have $100,000 income. We have standard deductions and an exemption of 10.4. So we have taxable income of $89,600. Our tax is $18,139. So let's stop there. That's very simple. Let's go back to let's go to the top of the new column. We have $100,000 of Schedule C income. We get a $20,000 deduction. We have a $12,000 deduction exemption in the new law. Our taxable income is $68,000. Our income tax, look how much lower it is, $10,899. These are real numbers with Trump's changes. Now, what I want to stress, though, now look below where it says self-employment taxable income. That is still $100,000. So that is your FICA you pay. So the self-employment tax is not changed. Very important. You're still paying the $15,300 on that. Your total taxes are $7,240 less. These are real straight numbers, very easy. So look at that savings that you get. That's why we want to make sure it's calculated correctly for you on your tax return. let's talk a little bit about New Jersey exit tax. There's a lot of questions about this I get all the time, and I want to go over that a little bit. So the exit tax is actually a tax payment made in the name of the client at the closing, which is subsequently used as a credit on a Jersey income tax return, unlike New Jersey realty transfer fees. So what they do with the closing, Jersey is afraid that you're non-resident of New Jersey and you're going to be in a state outside of New Jersey and you have a gain and a tax to pay, but they can't chase you anymore. That's what this is all about. So they want to grab that money at the closing. So this is the basic rule. If you're a New Jersey non-resident who sells real estate in New Jersey, you must make an estimated payment at the closing of almost 9% of the gain or 2% of the sales price, whichever is higher. So that's simple. Look at those rules, except if the federal sale of residence gain exclusion applies. So what does that mean? We have let's look at my example. We have a Florida resident who sells a former New Jersey resident. This happens all the time. Let's say you have a client that left New Jersey 2 years ago. Now they're a resident of Florida. They're finally selling their house. People think, well, that's a non-resident. We need to pay the exit tax. Well, that's not true. If there's no federal gain, the exit tax should not be taken, right? So the rule is, if you lived in that Jersey home 2 out of the past 5 years, then you don't have to pay a gain up to certain limits, right? If you're married, $500,000 of the gain can be excluded. So even though you're a Florida resident, if there's no federal gain, the exit tax should not be taken in that case. Right now, second example, you're a Florida resident, but you sell a second home here or a rental, the exit tax should be taken. The most important thing is when you see a closing, if the lawyer wants to take an exit tax, we need to evaluate it, because what lawyers do is they want to cover themselves, if you know what I'm saying, and they can take it and send it in, and then you still have to do a tax return in New Jersey to get the money back. So be wary of closings where people are not in the state to see what the lawyers are doing. And if there's a question, call me, because I'm dealing with these questions every day. Now, what if, though, you're selling a rental property and there's a 1031 exchange? Again, so that rule doesn't apply all the time. As I said, you might be exchanging a property, and if so, if you per federal rules, if there's no gain, then Jersey doesn't take the exit tax. See, so there's a lot of ways out of the exit tax people don't realize. Now, I want to talk about texting with everybody because I deal with a lot of commercial work, with a lot of legal work, and remember that text messages are vital correspondence, everybody. I want you to imagine that every text you send can be used in a court of law as a business communication, just like a fax could. So people are communicating more via text. I urge everyone, if you can communicate with an email where you can take your time, there's no harm in waiting. Be very careful what you're texting. And remember, we need to back up your text. So any brokers that might be listening to this eventually, or people that have staff or real estate agents under them, your team, you need to make sure they're capturing these for later reference in case there's a problem where where we have a he said, she said situation, and we don't have the text backed up from a year ago. So we need to make sure they're backed up and readily accessible in case we have a disagreement with a client. And hardly anyone's backing these things up correctly. And we need to make sure we need to test these things. Can I go search my text? Let's say Chris Whalen is the person, right? So remember, data backup, another good important. Everyone has contacts on their phone. Now, are your main contacts on your phone backed up regularly? What is the default database on your phone? Because what if you lost your phone and we needed to get at your contacts? Right? So everyone, please take a minute. Make sure, let's pretend that your computer is gone and your phone is gone. How long will it take you to get at your data, to service your clients? I often tell everyone, let's say that we need a disaster recovery plan, everybody. What if your phone and your computer is gone? How long will it take you to service your clients? Remember, clients, we all know clients have total allegiance and they will never jump ship if they're worried about your ability to serve them. Of course, kidding. So test this today. How long would it take you to be transparent to your clients to service them so they don't know that you've lost your computer and your phone? Very important thing. Test this, and if you can't readily do it, institute a plan. Ask me about it, please, so we can make sure you can readily get back up and running and no one is the wiser. All right, let's talk about real estate investing after Trump tax reform. a very important point here. So let's talk about 1031 exchanges. And everyone, this is complicated, it seems like to people, but this is the most important question, and this is meant to eventually give you new business, okay? So if a client does not need the proceeds from a sale of an investment properties, consider a 1031 exchange. Remember, the basic tenet of a 1031 exchange is that we can't take the money from the sale, right? If we take money, we have to pay tax on it. So if you know a client does not need the proceeds from a sale, always ask them. They should consider a 1031 for two reasons. One, it helps them move the tax down the road. They can defer that gain into the new property eventually, but also it gives you another sale, which is what we want. So this is the most important question to ask everyone selling a rental property. And also, they could also possibly do an opportunity zone investment, something a lot of realtors aren't conversant in, but I think all the realtors should be, okay? So what's an opportunity zone? It's an economically distressed community where new investments under certain conditions may be eligible for preferential tax treatment. Something Trump did. He said, instead of taking tax dollars and putting it into certain areas, well, why don't we give people an investment opportunity so it's not taxpayer dollars? Fantastic. So the good thing about an opportunity zone, separate from a 1031, is that you can defer the capital gain from anything and invest it in an opportunity zone. So I could sell stock. Let's say I make a killing on Apple computers, and I have a $500,000 gain. I can put that into an opportunity zone and eventually save some tax on that. So this is a selling point for you as realtors. Is the market crashed a few months ago? We can easily sell to our clients, hey, would you like to maybe get out of the market, get into a much more stable real estate market, because we know real estate always beats the market, which I'm going to go over an example in a few minutes. And they would love to diversify. So this lets them diversify a portfolio, a stock portfolio investment, sell it, and make a great investment into an opportunity zone that turns into a real estate investment, which is perfect for realtors, right? So why not just do a 1031 exchange, though, you might say? Sounds the same. Well, listen, a 1031 is more restrictive because you need a like-kind investment. So if I sell $1 million apartment building, I need to find a similar property of a similar price in order for the 1031 to work. So that's a little restrictive. But an opportunity zone, that's not needed. As I said, you can take a capital gain. You can take a capital gain from a rental property or a capital gain from stocks. So an opportunity zone is more flexible. I urge everyone to learn about this. There's great interactive maps online to show you in your communities and the state and the country where are these opportunity zones. Because a lot of realtors stick to selling forever homes, but that really restricts your opportunity to make money. So these are a great way to make money, sell higher priced commercial properties, and save taxpayers money, and it gets them out of the stock market and into real estate. It's a win-win-win for everybody. So the important thing about 1031s, the full proceeds need to be invested. Any money you keep, even partially, that little bit would be taxed. So remember that any money you take from a 1031, so people often come to me, Chris, I sold the property, let's do a 1031. If you got the money, it's too late. They have to keep that money with an exchange agent, it's called. You cannot take the proceeds and then still do a 1031. Very important for realtors to understand that. An opportunity zone, you only have to invest the gain. So let's say I had $1 million property that I sold and I have a $500,000 gain. To do a 1031 on that same example, I need to invest $1 million. The opportunity zone, I only need to invest the 500,000. Hope that makes sense to everybody. All right. Also, the longer you keep that opportunity zone investment, the more original gain that is forgiven. So that's a whole separate discussion, but opportunity zones are very specific. You have to keep your investment there, but it's a very, very good opportunity for long-term savings on capital gains. All right. So real estate opportunities with 1031 on opportunity zones, as I said, there's an expanded selling area. I'm very much into realtors thinking, listen, you can do a 1031 anywhere in the country. You can find like-kind properties for people selling commercial properties, right? Investors don't mind buying properties further away. So this expands your market area to sell properties from just Monmouth Ocean County to the full tri-state area. If you get conversant with it, so it greatly expands your opportunity to sell, right? Most agents ignore this though. They ignore this opportunity, and the realtors that take my advice are selling more. And think about it, they have more diverse, it's almost a separate profit center from selling forever homes. And that's a really good thing to have up top. Right now in the downturn, the investors coming to me to help them analyze properties have plenty of money to still buy. So they're not affected by the downturn right now. In fact, they're looking to buy up as many properties as possible. So this is the form for the like-kind exchange. Just wanted to show everybody, this is the form that you or a client would fill out, just the beginning of the form. That goes on your 1040 form. Okay. So let's think about tax reform hysteria versus tax reform reality, okay? This is a great section. I like this section a lot. So this is what we've been hearing in the news and still hear it. Your New Jersey home could soon be worth less. Here's why. Trump's tax plan will soon hit Jersey homeowners in ways they have not expected, according to Moody's. This is a quote from these articles. The tax reform plan will leave many taxpayers with less disposable income and wealth and less money for a house. Of course, that problem will ultimately cause housing prices to drop. That sounds terrible if you're a realtor. Oh my God, I've chosen the wrong profession, right? But no, it's totally fake news. Totally fake. I do this for a living. If you look at these reports, it's baseless. There's never any detailed analysis shown on really what the impact is in the high tax states. So I do this for a living. Very small amount of clients had any negative impact. It's mostly extremely positive. People have more disposable income than they did before, right? So our job as professionals is to educate. If we do that, sales will increase. That's why I do this, especially this section. Even realtors don't know if it's better. Trust me, everyone you talk to, 99% of them are faring better than they did before the tax reform, and they don't even know it. So I want you to have confidence that you can sell, right? In the market, we now have buyer paralysis a lot, right? They fear the tax changes might reduce home values, right? Everyone thinks that the real estate taxes, which are now limited as a deduction, which are intrinsic to the value, oh my God, we can't take them, right? And the realtors are not sure how to answer this, right? That's a bad combination, but it's good. There's a cure. The CPA can cure this with analysis, right? You're not tax experts, but you get tax questions. How should you handle this, right? So we don't want to overstep. Like, for example, if someone comes to me and asks me about a real estate closing or a sales contract, I wouldn't want to answer specific questions and overstep. That's your job. So what do you say? What do you say to people that might be nervous about this? Well, you say a seasoned CPA can analyze the tax impact for you. If you don't have one, please let me refer one named Chris Whalen. Perfect answer. But no, seriously. This is what you can say. Since the new laws were passed, you worked closely with a CPA, analyzing many scenarios, and we found very few where there was a negative tax consequence. That is a great way. You're non-committing. You're not talking about the numbers, but it allows you to confidently allay their fears, which is what we want. We want someone in front of me that gives us a roadblock to tear that down easily and go on from there. Very important point. So many families have more after-tax income, right? You should be selling higher-priced homes more often. Trust me, it's true. So let's talk about the itemized deduction still, what's happened. I know it's a year or so ago, but what's happened to them so you understand. So let's talk about mortgages for a second. The mortgage interest deduction has always been limited, and a lot of people don't know that. So before 2018, if you had a mortgage loan over $1 million, you couldn't take all the mortgage interest. So let's say you have a $2 million mortgage and your mortgage interest is $20,000. You could only take $10,000 of that. It's limited. So after 18, that threshold comes down to $750,000. So if you have $1 million loan with $10,000 of mortgage interest, you can only take $7,500. That's how simple that is. But it doesn't affect a lot of us. A lot of our clients don't have that. But in case they do, this is an important thing to know about, that there is a limit on mortgage interest you can take. Now, what if mortgage rates are increasing? We're not right now, but what if they did? But tax savings offset this. People are still in the mindset of pre-Trump era taxes. So even if rates go up a little bit, the amount of tax savings sometimes dwarfs that increase in payment every month. And I'm going to go over a few good examples here, case studies of pre-Trump and after Trump, and we're going to go over that. Now, home equity loan interest is very important. It's mostly disallowed after 2017, but acquisition indebtedness is still deductible. I'll go over that in a second. Remember, the interest used for any other purpose is no longer deductible. If I go to Aruba, if I pay for college, if I do anything other than improve my home or refinance my first position, I cannot take that HELOC. Very important, you're honest about this. And the IRS is this is something very specific they will ask you about. So be very careful if you take the HELOC interest on your tax return. Now, acquisition indebtedness, what does that mean? People think, well, that means when I buy a house, but it's really a little misleading, right? This is indebtedness that where you bought the house, but it's also if you improved it. So let's say that you use a HELOC to put a pool in or put an addition in. That is still considered acquisition indebtedness because it includes that. Very important point. If you take a HELOC and you have refinanced your first position, as I said, that can still be taken as a deduction because the original loan that you refinanced is acquisition indebtedness, right? Now, mortgage insurance premiums are deductible partially, but only if your income is about under $100,000. So you got to be careful with that. It is partially deductible. Now, it's still deductible on rentals. And remember, everything is still deductible on rental income and rental properties. This only applies to your residence. And people are making the mistake of thinking all these restrictions or changes apply, but they don't apply to rentals. And it's very important to tell people coming to buy investment properties, they think that this applies to their rental properties they're going to buy, but it doesn't. So there's still plenty of deductions. It's still as good as it always was. Very important to impress that upon your investment property buyers. Okay. Now, the child tax credit is very significant because there's a lot of middle income people that now get up to $2,000 per child that never got anything. So prior to this, if you were a couple making about $110,000 or less, you got $1,000 per child under the age of 17 at the end of the year. So a lot of people that's not middle income anymore. That's an old amount of money if you think about it as a limit. So what Trump did, he made it $400,000 for married people as a limit, which is fantastic, and he made it $2,000 per child. So imagine your homeowners or home buyers who are now making $200,000 or making $200,000 a year with 2 children. You'll see in our example, that's a great boost to their net after-tax income, which of course can be used for a house or a bigger house. All right, so let's talk about these SALT deductions or state and local tax deductions. So we're going to talk about the impact of eliminating them. And these are deductions, again, they're limited to $10,000. State income taxes you pay or real estate taxes are limited to $10,000. All right, but there's hysteria still in these high tax states, California, New York, and New Jersey. Remember, I put up that Moody's article earlier where, it's going to crush home prices, but of course it has not in any of these states at all. So here's an example. I want to take our time here. It looks a little busy, but this is the 2017 is pre-new tax reform law and 2018 is after. This first example is a great customer for you. This is a renter. These people are renting. And so the first 2 columns I want to show you is 2017 and 2018 with no itemized. So let's take a look at how the tax reform helped them. They have $100,000 in wages. They have no itemized deductions. They're not a homeowner. They got a standard deduction of $12,700. They got exemptions of $16,200. Very simple. Their taxable income is $71,100. Hope everyone follows that. Their income tax is $9,736. They got $2,000 of child tax credit, as we just discussed. They're under $110,000. 2 children times $1,000 each. Their net tax is $77.36. Hope everyone follows that. If not, let me know. So now let's say that they did not buy a house, but they're still renting. So how did they do under the new tax reform? And does this help them buy a house or not? Which is the very important question. So still they have $100,000 of income. Now they have a standard deduction which went up to $24,000 from $12,007, which seems to be fantastic, but the exemptions are taken away. So let's take a look. Their taxable income is higher. It's $76,000 versus $71,100. That seems like a tragedy. Oh my God, this is what we were talking about with limitations. But wait, their income tax is lower. Their income tax, even though their taxable income is higher, their income tax is lower. $8,739 versus $9,736. So just stopping at that line, we have about $1,000 savings that so they can afford at least the same house or greater house you were showing them. This is a very important point. Now, but wait a second. Now that they get a $2,000 per child tax credit, which now brings their net tax to $4,739. So their savings is almost $3,000. So just think about almost that $250 to $300 extra per month. We can definitely get them even to a bigger house. So very important point. And this is true across the board for renters, depending how much money they make. So again, I do this so you have confidence that you can tell them. I urge everyone to get my slides, print this out at your desk so you can refresh yourself. Again, a lot of realtors don't have confidence selling to the tax code. And I want you to have that, because realtors that don't come to a seminar of mine, a lot of them are lost, right? So let's now go to, let's say they did buy a house. This is something to show them. So they're going to have some basic deductions here: state taxes, property taxes, interest, and charity. So now they have $26,500 of itemized deductions. That's higher than the $24,000. So of course they take that. But their taxable income is still higher than the 2017 non-itemized. Look, they have $73,500. It's lower than the 2018 not itemized, right? But their income tax even lower. Their income tax is $300 lower than it was than the 2018 without itemizing. So now they have the $4,000 child tax credit. So look, if they bought a house, they're saving even more money, $32,097. I bring that up because people think, oh, I'm going to be paying more money for my mortgage possibly. But look, there's a tax savings, another $300. So across the board, you can see selling to a current tenant should show them how much better it is and that they're not losing anything. And even with the limitation on deductions, they're still doing fine. All right, hope that explained that properly. I know it's a little busy. So let's go to the next case study. So here's the same family. They make a little more money. They make $230,000, and they own a house already. So let's take a look at how it was in the old law and how in the new law. So here we have state taxes of $9,000 and property taxes of $9,200 in the 2017 column. All right. Now that goes over $10,000, and we're going to see this is where that limitation happens with those two line items. They have mortgage interest of $13,000 and charity of $2,000. All right, so their itemized deductions are $33,200. Now they have personal exemptions for them, which were still applicable in 2017. That's $16,200. So their taxable income is $180,600. Their income tax is $37,453. All right, let's go back up to the column, the 2018 column. We have $230,000 of income, but look, our state taxes are limited to 5, and so are property taxes. I've taken away $8,200 of deduction right there. Think about it. My mortgage interest is still fully deductible. My charity is still fully deductible. So, but look, my total itemized deductions are $25,000, down from $33,200. That's $8,200 less. That gets everyone scared to death, and that's what the media wants you to be. And also look, the exemptions are gone. So look at our taxable income, everybody. It went up from $180,600 to $205,000. Almost, right? We have $25,000, almost $25,000 of additional taxable income. But look how close the tax is, because what Trump did, he reduced the rates. He got rid of the alternative minimum tax. So even with $25,000 more of taxable income with limitations on deductions, they only have a tax increase of $325. That's a break even to me. I can still sell them the same house. That's the important thing. Or look at this. I had to push this example even to get a negative number there, that 325. But wait, they have children. Even 1 or 2 is great. So now they're under the $400,000 threshold for property tax credit. Okay. And that means they have a $4,000 credit, which brings their tax down to $33,778, right? That gives us a savings of $3,675. Even if it was only one child, they'd have a savings of $1,675. So even with this, losing some itemized, we still have a positive benefit. Lauren, do you mind if we just take a 5 or 6 minute break?
No, that's totally fine.
All right, good. I'll be back just in a couple of minutes. I know I want to give everyone a chance to take a break. I know I've been talking for a while. Okay?
You got it. Perfect.
Thank you. All right, I'm back. Anybody have any questions for me? And hopefully you can see me. Okay, I got a question. Ellen, can you hear me? I see your question. I just want to make sure you can hear me.
You're good. We can hear you, Chris.
All right, great. So yes, the unemployment can be taxable. So that's part of when you get the PPP and the unemployment. Remember, there could be a tax effect on that. So we want to make sure that when if we're close with the PPP number deciding, yes, there should be taxes on that unemployment as of now, even though it's federal unemployment. But who knows? The government might change that. They might make that not tax. But right now, assume it is. Assume you're paying tax on it. Okay, and you can see me okay right now? I want to make sure there's any other questions. I think we can continue. All right. I want to make sure I answered all the questions. You think we're ready to continue?
We're ready, but there's a question that just came in from Patricia Kavoris.
Okay, also for business expenses, we have a standard and 20% deduction. Right, so let's, there's two separate things she's talking about there that are unrelated on the tax return, okay? So we have your business expenses go on your Schedule C. That relates to your net income or loss from your real estate commission. And so, yes, you would get you get a 20% deduction on that portion of your taxable income. Now, your standard deduction is something that you compare with your itemized deduction. So they're two separate things. So if you, like in my last example, if there was one of the examples I gave you, there was a, let me share my screen again. All right, hopefully you can see my my case study up again. Just let me know if you can see that. All right, so hopefully you can see my screen. Yes, you have a choice between taking, if you're married, about a $24,000 standard deduction, or if your itemized deduction, such as you see on the screen, taxes, interest, charity, if that goes over that number, you take the itemized instead. So your business expenses, yes, have a lot to do with that QBI 20% deduction eventually, but they're not related to your standard or your itemized deductions. Does that make sense? Let's see. Patricia, thank you. Patricia says yes. All right, great. All right, so I'm going to continue on to our next example here, if that's okay. Okay, so now this is another example. I just want to quickly go through. This is someone making $500,000. So this could be your potential client. So let's take a look quickly. I know I've taken some time here, but let's look. So they have itemized deductions in this case of $75,000. We could see what is that comprised of. Our taxable income is $425,000. So let's look to 2018, the new law. They lost $35,000 of itemized deductions. Sounds, again, oh my God, this is the fear we have. And look, their taxable income is $460,000, but their tax is $15,000 lower. Again, the media focuses on the loss of these deductions, but they don't show you how much the rates have come down, the margins have moved. So look at this example. Very clear. You could have a couple making this much money. They could be nervous about this and say, look, they have more money to buy a bigger house. One more example. Let's go to the $1 million couple. Same thing. Let's quickly look. They lost $105,000 of itemized deductions. They went from 205 to 100. They still save money. So every example I give, even that one where there was a $325 increase in tax, it's very hard to find someone, even with these limitations, who is hurt with the taxes. So I tell everyone, tell the agents I deal with, we have to come away from selling the houses. Oh, we can take the real estate tax deduction now. And we really have to talk about, oh, what is your net after tax income with all of these great tax changes? So that's how I've changed the whole conversation, and shift people away from the real estate tax focus to the net after tax. And then look, if you give them these kind of examples, or of course, if you send them to me to analyze their taxes before and after, or right now, I can easily show them how much more money they have, which then helps you sell the house much quicker, right? All right, let's go on. Remember, for rental properties, there are no limits, everybody. So everything we just talked about, equity loans or real estate taxes or limits or SALT deductions, does not apply. There are no limits to taking deductions on rental properties. So you might get that question, and you can confidently tell them it doesn't apply. They're still fully 100% deductible. All right, so let's talk about one of my favorite sections here is real estate versus the stock market. Which is the better investment? So if I ask everybody, someone walks in the office, says, listen, I have $500,000 to invest. I can put it into Fidelity, into gold, under my mattress, or I can invest in real estate. Tell me in 2 minutes why it's better and safer to invest in real estate. Everyone you ask will tell you the stock market is safer than real estate. And remember, that's a complete lie. And how come people believe this? Well, that's because the big brokerages like Fidelity and Goldman for the past 60 years have been telling people that it's terrible because they don't make money on it. So they've demonized it, and a lot of people believe it, but it's totally not true. Real estate done the right way is much better. All right, so let's say real estate always knocks out the stock market. Again, done the right way. There's no doubt, and I want every realtor listening to know that they can confidently say that. So this section has 4 parts. We want to understand the difference between home buyers and investment property buyers. We want to compare the risks and the benefits and the level of control of real estate versus the stock market. I have a case study, a 20-year case study comparing and contrasting. And I have what I call an investability analysis, which I have a simplified version of what I do for clients that hire me to analyze properties. That's going to give you some insight into how you can do it. And I urge everyone, and when I get to that section, every property that you have that's listed, you should do an investability analysis and market it completely separate to a separate type of buyer. Just to, again, a lot of people don't do that, and it helps you sell the home much, much faster. All right, so real estate agents and brokers should pay close attention here. Right? To many realtors, too many realtors don't understand how to sell to investors and how to analyze their listings for investability. And so they miss out on an entire market wanting to buy. Very true. Now, why real estate? So let's look, this is very important. Great little chart I found, but it really explains, look at real estate, look at all the attributes it has, all the green dots. It's a real asset, a hard asset. There's a tax advantage if we could take losses. We can build up equity in that home. There's a high cash yield if it's paid off. Now look at it compared to other things. Stocks only have one item. Oh, you could build up equity. But look, there's yellow and then there's red. There's items that are only spotty. And look at the bonds. Look at the cash savings. So nothing else have all of these positive attributes in one place. And again, people don't realize that. Even realtors don't realize, wow, look at all these great attributes that real estate has compared to other things. So let's part 1. We want to understand the difference between home buyers and investment property buyers. So here, the same house. The strategy to sell investment properties is not the same as selling homes. Investors share some of the same concerns as home buyers. Investors want return on investment, safety, stability, not a place to make decades of family memories, okay? So we have a family here. What's best for my family? We're all used to this. You've all been trained to do this with your eyes closed. But remember, investors on the other side, they care what is the best bet. Totally impersonal. I could put my money in real estate or something else. Why is this the best bet for me for the long run? So it's a completely emotionless sale compared to a forever home. So the sensibilities of the buyer are completely different. And we need to learn about them so we can sell to them. So here's some home buyer priorities, which you guys all know all too well. We love upgraded kitchens and big kitchens, open floor plans, technology, energy efficiency. Now look at the two on the bottom. These are the only two that are shared with an investment property buyer. Good location and low maintenance. The other two they don't care about. The other five they don't care about. This is what investors want. Clean space, good location, low maintenance, ROI. They want long-term cash flow, low technology. They don't want high technology because that's high maintenance costs, right? And someone else is paying for the asset. There you go. What's better than that? So when selling, that's why when people even look at investment properties, when realtors size them up, they think that they're not upgraded enough, but that's sometimes they're thinking of selling to families. Remember, there's a totally different mentality when buying a rental property. It could be perfect if it's not upgraded, especially with technology. So let's compare the risks, benefits, and level of control with real estate versus the stock market. So this is very interesting. If you ask anyone, oh, there's such a high risk in real estate, I better put everything in the market. But it's completely untrue, right? I want everyone to take a little aside here. I'm old enough to remember Evel Knievel, and I bring him up for a very important reason. For those of you to know, Evel Knievel was a 70s and 80s daredevil who jumped his motorcycle over things like the Caesar's Palace fountain or 60 buses, right? Or cars. The important thing is that Evel Knievel, he got insurance jumping motorcycles. Let's think about that. Someone thought that this crazy person jumping over buses, he was an insurable interest. But this is the question. If we can get insurance on investment properties, but not stocks, maybe investment property is not as risky as we have been told, right? Think about it. If an investment advisor wants me to invest in Google, I say, well, can I get insurance on that? If Evel Knievel can get insurance, think of how risky stocks must be. That insurance company would never. So that's an important point. Very important. Now listen, I'm going to go through a stock market investment and investment property investment and the attributes of each and in each line item. So this is very important to remember. This is a really good slide when it's done to print because it really shows your buyers what's better and why. Okay, so here, stock market. Hey, it's been proven the past few months it's volatile and unstable. I don't know, it went down 30% in 1 or 2 days. Very volatile, very unstable. Remember, the valuations of stocks are not based in reality. It's not. Why is Google worth what it's worth? Why is Apple? It's not like it was 100 years ago where it was based on balance sheet and how much is something really worth? How much is a company worth? You can't hold or touch this asset. It's a digital something somewhere. I own Google, but where is it? I can't hold it. I can't put it in a safe, really. There are many things out of your control that impact value. Think about that. You have no control over this big investment you've made and how much it's worth. You're totally at the mercy of the market and the stock market and other large investors. There are wide swings of gain or loss with the stock market. Again, we've proven that. We've proven that for the past few months with the lockdown. And we can't insure against normal losses, which we just went over a minute ago. What if the stock market crashes? I can't insure against that. And people accept this. I don't know why anyone would accept this as and say that it's a valuable asset when I could lose 30% of it in a day and there's no insurance. That sounds crazy to me. Now let's look at the investment property, the same exact attributes. There are stable values. Hey, when we had the stock market crash a few months ago, the real estate market didn't drop by 30%. That sounds a lot more stable and better to me, right? The valuations are based in reality of the market. We have comps, right? We have history. We can look at things and we can see why is a condo next to mine? What did it sell for, right? We can hold or touch it. I have rental properties. I can go and touch my shed. I can look at it. I can hold it. It's something real. And there are many things that are in your control. Think about it. I can upgrade my windows. I can upgrade my decor. I can upgrade my driveway. I can have the same exact house next to mine, and my house can be worth more because I have control over that. That's worth everything. I have small swings of gain or loss. How much? We don't have a 20% swing any day or week. I mean, that sounds a lot more stable to me, and we can insure it against losses. Flood, hurricane. So take a moment and let's look at these two columns. And if you were to, and I'm going to go to the next slide, but it's going to be similar to this. Now watch. If I told you without knowing it's real estate or the stock market, I investment A or investment B, if you looked at this, where would you put your money? I would never put it in investment A ever. So that's really the key to this is take away the investments and say what's better. There's no doubt if we look investment B, which in this case is real estate, beats in every category the stock market. I hope we all agree with that. Part 3. Now, this is a case study of it's a 20-year comparison where a client has $200,000 to invest. And I'm going to do a comparison between real estate and the stock market for over a 20-year period with this. And this is really informative, and just, I know there's some busy slides here, but let's just take our time. So we have, this is a common question I get. I have Chris, I inherited $200,000. Should I invest in the stock market or real estate or something else like we talked about? Okay. So I'm going to compare a $200,000 Google investment today with 4 $200,000 condo investment properties with $50,000 down each. So at this moment, I'm buying $800,000 in properties. Yes, I will have $600,000 in mortgages on it. But let's see over time what happens and what's the benefit or not. So first of all, let's just look at value of the asset. We're not even talking about income yet. So I'm going to give Google a 10% increase in value every year with no loss, no reduction. That's pretty good, and that's being, pretty gracious. But that would mean in 15 years, my Google is worth $835,000. Hope everyone can follow this. Pretty straightforward. That seems like a really good return on my investment. Now, remember, I bought 4 rental properties for $200,000 each, and the average increase in residential real estate is 3.4% across the country. We all know that. So that means after 15 years, I have $1.2 million of value, and my mortgages are paid off. So let's take a look. So this is just value of the asset. So my rental property benefit, I have $373,000 more in asset value than Google. And I've given Google 10%. I've really been gracious to them. And I've only given us 3.4% average. So look at that. So that's a good thing also to show investors is, wait a second, and the mortgages are paid off. I now have almost $375,000 of greater fair market value in equity. So that's just the beginning of how great this is, okay? So remember, at day 1 of year 16, my rentals are paid off. This is very important. So I'm assuming a net rental income total of $4,000 or $1,000 each. So that's $48,000 of passive income that's lost annually if your money is locked into Google. Think about that. Day 1 of year 16 with Google, I don't have any passive income every month, no dividends, let's say. Very important point. That leads me to this great benefit. So day 1 of year 16, in order to get your money out of the stock market or Google, you have to sell the shares. I have to sell Google, right, to match that passive income. So let's take a look at this spreadsheet. It's a little busy, but it's easy to understand. So in year 16, I have $48,000 from my property. I've gotten that without selling anything. So if you look at my property value, it's $1.249 million. My Google value has gone down because I've had to sell some. So if you look at that, my real estate over Google is now going up every year. So I want you to look at the Google value column. In order to get $48,000 out of Google, I need to sell about $65,000 of it. That's why it keeps going down by $65,000. Look at my property value. I'm getting $48,000 of passive income, and my values are still increasing 3.4% without selling anything. This overwhelmingly will crush the stock market investment. This is where you can't beat it. Remember, when I buy a rental property, the good thing about investment properties is I don't care if it increases in value. That's the other investment property mentality you have to understand. This goes against everything we've all been taught, because investment property owners don't want to sell them. They want to get to this point. So the benefit, the value is in the buy to analyze it for lease or rental. They don't care if it goes up in value, although it will. So that's a very important point with investment properties. They don't care about that. They want this, exactly what you're looking for. They want to buy it outright and start this, or they want to get a mortgage paid off. That's why I urge people to get 15-year loans and make it work. So on day one of year 16, we have exactly this situation, and hopefully we can all see why it beats the stock market. So let's talk about an investability analysis. This is a brief overview of how I analyze investment properties, okay? So the most important component to analyzing a property for investability is to know an accurate fair market value rent. That is the most important thing, and that's something I can't readily do. You have to do it. This is where a seasoned real estate agent is critical to my clients, because I don't rely on me to do that. I look to someone like you. And I'll show you why. So we have, let's say you have a $325,000 property you just listed, and we want to see, can we rent this though? Can we now list it? Can we now market it to investment property buyers? So we know that the fair market value rent is $2,400. Great. We're going to have expenses of taxes and HOA. So that means our total expenses are $750. So what that leaves us here is $1,650 that we can spend on a mortgage to break even. Think about that. $1,650 plus $750, working our way back up, is $2,400. So what I do is I back into a 15-year loan, in this case at 4%. You would put in whatever the current market rate is for commercial real estate, and I came out with a $223,067 mortgage. Okay, great. So this is the first thing we need to do. Then let's go a little further, because we need to figure out, well, does this make sense? How much do we need down on this? Okay, so our purchase price is $325,000. Our mortgage to break even is $223,067. That means we need a down payment of $101,000. Now that's 31.36% of our purchase price. So that's right in line with what the banks are looking for right now. 28 to 34% down on an investment property. I also include 10% of that number as fix-up expenses, because you're going to have a few things to do. But I urge my clients who are not contractors, if you need to go above 10% of your down payment to fix this up, then it could become a money pit. So that's almost my rule of thumb. So my out-of-pocket upfront is $112,126. Fantastic. So now clients will say, wait a second, we're breaking even. We don't have any tax benefit. But that doesn't matter right now, because you're getting a tremendous return on investment. This is what realtors miss. So let's think about it. This mortgage is being paid off over 15 years, $223,067. That divided by 15 years gives us our principal paid annually of $14,871. Think about that. So our down payment was $112,000. So now we're getting our debt paid off at a rate of 13.26. Think about it. If my net debts are going down, my net assets are increasing. So this return on investment is something to promote. Look at that. They have no tax. And the good thing about this return on investment of 13.26% is that it's not taxable. Think about that. They're paying off $225,000 almost of your mortgage. You never pay tax on that unless you eventually sell it. So this is hard to beat. There's very hard. There's nothing that comes close to this in the market, even if you're getting some gain. So look at that number. Many of you might not have realized this. Of course, my full investability analysis is much more detailed, but I wanted to give you a real good example of how do you start thinking about marketing your listings that might not be moving to investment property buyers. All right. I want to talk about the residence sale gain exclusion a little bit. A lot of you know about this, but some people still think the old law applies. So what happens when someone sells their home at a gain? The old rules say that gain reduces the basis of the new home. I have a $200,000 profit on my residence. I bought a house for $500,000. My new basis of the new home is $300,000. That's the old rules. Right now, for many years, the buying and selling of a residence have nothing to do with each other, right? Sales are not related, okay? If a single seller sells a home and they've been there 2 out of the past 5 years, $250,000 of the gain is not taxable. A married seller, $500,000 of the gain is not taxable, right? So I think I've come to the end. I know I took a long time today. I hope you found this worthwhile. Please email me your contact info, subscribe to my blog, and does anybody have any questions? And you should be able to see me now.
One just came in, Chris.
Okay, I'm going to punch out my questions here. Okay, let's see. Thank you, Louise. Let's see. Okay, question is, collecting both unemployment and federal extension. Well, let me just get this so I could read it. Well, I have to pay back unemployment amounts, right? So the federal, yes, possibly, yes. You can't accept both in the long run. So whichever is larger, we're going to keep that one and eventually repay the other. And again, some people, we don't know how much you're going to get. They might add to the $600 with more weeks. They might take it back. So I'm urging everyone to just hedge a little bit and don't spend both right now. Very important. You can't keep both. But remember, the PPP could be forgiven, part of it. Remember, as sole proprietors, if you have home office, a lot of realtors do, remember, only 73.85% of your PPP can be forgiven. I have a very important blog post about that. 100% can't if you don't have regular commercial space where you pay rent. So remember that if you do select the PPP and you only have a home office, part of that will be a loan if you keep it. So be very careful with that. You could write to me or go to my blog. I have a very, very good blog post explaining that. I don't want people spending all of that money thinking it's all forgiven. There's a lot of misinformation out there. Okay, does the accountant determine this? Patricia, does the accountant determine which one's better? Yes, I mean, all my clients, they would rely on me for things like this to definitely show me all the information and what they got. And then we have to figure out, is there a tax on the unemployment? Okay, Ellen, I'll definitely get you subscribed to the blog, no problem. So, Patricia, I hope that answered your question. That, yes, you want to have it analyzed because unemployment can be taxable. And depending what your rate is, you might get 10,000 of unemployment, but that might cost you 2,500 in tax. So really, you're netting only 7,500. So you need to look at that if you're close. If your PPP is close to your gross unemployment, if it's close, a lot of people make a lot of money or less money, then it's pretty easy to decide now. But there are people that are in the middle. And so it's no problem hedging, and eventually you'll pay back the one that's lower. Well, I hope I covered everything and a few extra things. Right, okay, so it's a good question, Patricia. Is this paid back at tax time next year? Well, what's going to happen is with the PPP, the next phase of PPP is going to be in a few months. The banks who wrote the PPP or what were the conduit for the PPP are going to ask you for proof that it should be forgiven. So that's the time where you're going to tell them, oh, I'm not going to keep it. I'm going to pay it back. So that's when, so if that happens, then yes, the unemployment which you keep will go on your tax return at the end of the year. But if you decide to pay back the unemployment, that's going to be a whole process you go through there because you want to make sure they don't give you a 1099 at year end for unemployment. And so that's going to be a whole process too with the unemployment people. And that's probably going to be a little cumbersome. So again, we just have to wait and know what our intentions are. But again, they're going to ask for PPP forgiveness information, and that's probably going to be in a few months. There'll probably be a window of a few months. But I think at that point, we're going to know what's better. And then if we're going to pay back the PPP, we will. If we're going to keep it, we will. And then we'll show them what we have for forgiveness. And then we'll send back the unemployment money. Now, what could happen, one last thing, is that if you don't do that, if you keep both, they're probably eventually going to know that you kept both, and then they might request the money back from you. So that's also something you could do, is that knowing that the state's done a pretty good job of doing this programming of the website, but you might want to wait, and it's still doing nothing illegal. You might want to wait for the unemployment system to catch up and know that you were paid the PPP and kept it, and then they might ask you for the money back. So that might be also something that, depending if the state doesn't get their system together for this, that's going to be my recommendation then, is wait. I want to wait. I don't want to go on a system where we're late again. We have to wait weeks. I'm going to wait to the very last minute. I want the state to write to me and tell me I have to pay that back. So that's either going to be one, pay it back if I know the system's working, or we're going to wait for that. So again, don't be nervous. You have every right to wait for them to get the systems together so we know we're not wasting time or money. Right.
All right, Chris, I think we're pretty much wrapped up. I want to thank you on behalf of the association.
Well, thank you very much, everyone. I hope you got something out of it. Again, please always email me with questions, get on my blog, but I'm here to answer questions, especially to all the realtors. So again, thank you, Patricia. Again, get on my blog. But again, thank you everyone for listening. I try to be as informative as possible. I know what it's like to go to seminars and just be put to sleep. And this is hard to make fun, as you can imagine. Well, have a very good night, everyone. Stay safe. And I hope to hear from all of you very soon.
Take care, everyone. Thanks, Chris.
Thank you.